Welcome to Skytech-Lens. On August 7, 2025, the Trump administration stunned global markets by slapping a 39% tariff on Swiss imports, an announcement that sent shockwaves through trading floors from New York to Zurich. The move was abrupt, catching even seasoned analysts off guard, and within minutes, financial news tickers blared with urgent updates. Investors scrambled to make sense of the implications, as the world's attention zeroed in on Washington's latest economic maneuver. The new tariff was more than double the rate imposed on the European Union, signaling a targeted escalation. For many, it was a clear message. Switzerland, long seen as a neutral player in global finance, was now in Washington's crosshairs. The official justification? A staggering $48 billion trade deficit, largely attributed to the immense volume of gold flowing through Swiss refineries and vaults. Switzerland, a global hub for gold trading, had become a focal point in America's effort to rebalance its trade books. But this was more than a simple trade tweak. It was a bold act of economic warfare, aimed squarely at one of the world's most influential financial centers. The Swiss banking sector, renowned for its stability and discretion, suddenly found itself under siege. The real panic hit when U.S. Customs clarified that standard 1 kilogram and 100-ounce gold bars, the backbone of the international gold trade, would now be subject to the full force of the new tariff. These bars, trusted by central banks and investors alike, were suddenly caught in the crossfire. Overnight, the economics of Swiss gold exports to the U.S. collapsed. Warehouses that once buzzed with activity fell silent, and trucks loaded with gold were halted at border checkpoints. Export facilities posted closed signs as the industry ground to a halt. The Swiss Precious Metals Association responded swiftly, halting all shipments to the U.S. Emergency meetings between Swiss officials and American diplomats failed to produce a breakthrough, leaving the gold trade in limbo and diplomatic relations strained. This wasn't an isolated move. Washington was simultaneously ramping up pressure on other major trading partners, India, Canada, and the EU, by targeting their key exports. But the gold tariff stood out for its potential to disrupt the very foundation of global finance. Gold is not just another commodity, it's a pillar of trust in the international monetary system. By targeting gold, Washington was striking at the heart of the global financial order, sending ripples through central banks and investment houses worldwide. The disruption threatened the very reliability of international markets, shaking faith in the rules-based order that had governed global trade for decades. Investors watched in disbelief as volatility spiked and uncertainty spread. The shockwave wasn't just about gold prices, it was about the stability of the entire system. In a single stroke, Washington had upended decades of financial norms, leaving the world to wonder what might come next. The aftermath of the tariff was nothing short of chaos. In the blink of an eye, the familiar rhythms of the gold market were shattered, replaced by confusion and panic. Traders who once relied on stable price relationships suddenly found themselves in uncharted territory, scrambling to make sense of the new reality. On COMEX, gold futures prices exploded upward, smashing through previous records as buyers rushed to secure contracts. The surge was relentless, driven by fear and uncertainty about future supply. Meanwhile, in London and Zurich, the story was completely different. Physical gold traded at a steep discount, as if it were suddenly less valuable simply because it was on the wrong side of a border. The gap between futures and spot prices ballooned to nearly $100 per ounce, a staggering divergence that signaled deep market distress. This kind of spread was almost unheard of, a red flag for anyone watching. Under normal circumstances, arbitrageurs would have stepped in, buying cheap gold abroad and selling it in the US to close the gap. But the new tariff turned this into a dangerous gamble, making every shipment a potential financial disaster. The result was paralysis. Arbitrage froze, and with it, the market's sense of order. Confidence, once the bedrock of trading, simply evaporated. Now, traders faced a new and unfamiliar risk. Not just whether prices would rise or fall, but whether they could even deliver gold at all. The logistics of moving gold became a nightmare, with paperwork piling up and shipments delayed at every turn. Every transaction involving the U.S. now carried a hefty risk premium. Catastrophic tariffs, unpredictable delays, and a fog of confusion hung over every deal, making even routine trades feel perilous. The chaos didn't stop at gold, it spilled over into derivatives and collateral markets, forcing banks to lock up more capital just to manage the uncertainty. Liquidity drained from the system, amplifying the sense of crisis. The tariffs' impact rippled outward, threatening to slow the broader economy. As capital was diverted to cover this man-made risk, investment and growth began to stall, and the specter of a wider financial crisis loomed. In the end, the market's faith in the U.S. as a reliable counterparty was put to the test, raising uncomfortable questions about trust, stability, and the true cost of protectionism. At the canter of the storm was the 1-kilogram gold bar, the backbone of global gold trade and U.S. futures settlement. The U.S. customs ruling targeted these bars, blocking imports from Switzerland, the world's top producer. This created an instant bottleneck, making it nearly impossible to satisfy U.S. demand efficiently. Arbitrageurs who relied on predictable rapid delivery suddenly faced delays, reclassification risks, and massive taxes. The disruption drove the future spot spread wider as costs and risks soared. These bars aren't just financial assets, they're essential for jewelers and electronics manufacturers. By choking off this supply, the tariff threatened industries far beyond Wall Street. Faced with a sudden wave of uncertainty, Swiss refiners, the world's gold processing giants, made a drastic decision. They stopped all US-bound shipments overnight. For decades, these refineries had been the beating heart of the global gold trade, their vaults and furnaces running around the clock to meet relentless demand from American buyers. But now, with new regulations looming and no clear guidance from authorities, the risk of sending gold across the Atlantic became too great to bear. The threat of gold being impounded, heavily taxed, or even confiscated at the border was simply too high. Production lines dedicated to U.S. orders went silent, machinery stood idle, and workers waited anxiously for news. The once bustling factory floors filled with the clatter of gold bars and the hum of conveyor belts now echoed with uncertainty. Logistics firms like Brinks and Loomis, responsible for moving billions in precious metals, quickly grounded their U.S. flights. Warehouses began to fill up with unsent gold, and insurance costs for any attempted shipment soared to unprecedented levels. The entire logistics network, built for speed and reliability, was suddenly paralyzed. The shutdown was immediate, decided in hours, not days, demonstrating just how fragile and interconnected global supply chains are when faced with sudden shocks. In control rooms and boardrooms, urgent meetings stretched late into the night as staff scrambled to adapt to the new reality. The paralysis rippled outward. Assayers, insurers, and customs brokers, vital cogs in the machinery of international trade, were left in limbo, unable to advise clients, process paperwork, or move shipments. Their phones rang with questions they couldn't answer. Without clear rules or direction, the entire apparatus of cross-border commerce ground to a halt. Shipping terminals stood deserted, cargo operations froze, and border checkpoints closed their gates to gold. The system, engineered for speed and efficiency, proved shockingly vulnerable to arbitrary policy changes. Charts tracking the flow of gold now showed only red warning symbols and empty lines. The entire gold trade's ecosystem, from refiner to retailer, was frozen in place, with workers and business owners alike waiting for clarity from Washington, hoping for a signal that it was safe to resume. In the end, the world's gold supply chain was held hostage by a single ambiguous policy, its fate suspended, as everyone waited for answers that never seemed to come. The 39% tariff was shocking, but ambiguity made it worse. The White House and customs rulings were maddeningly vague. Did the tariff hit cast bars, minted bars, or both? Did origin mean mined or refined? Compliance teams were left guessing, and every shipment became a gamble. Uncertainty was more damaging than the tariff itself. A known cost can be managed, but unknowns paralyze markets. Arbitrageurs, unable to calculate risks, withdrew, letting price gaps widen unchecked. The episode proved that markets can adapt to any clear rule, but not to regulatory fog. The confusion froze commerce more than the tax itself. In a global economy, clarity is as vital as capital. The real accelerant of panic was not the tariff, but the darkness of not knowing where it would strike next. The gold tariff's impact quickly spread beyond trading floors. American jewelers faced immediate price hikes, forced to raise retail prices or risk their margins. Higher costs meant tying up more capital in inventory and risking supply disruptions. Bad news for small businesses. Electronics manufacturers, reliant on gold for critical components, scrambled to avoid production delays. The halt in Swiss shipments threatened to disrupt everything from wedding rings to smartphones. The ripple effect showed how a single tariff could trigger a cascade of costs and delays across industries. The global economy's interconnectedness meant a shock in Switzerland was felt on American high streets. Every link in the chain from refiner to retailer was affected. In the end, it's ordinary Americans who pay. Tariffs on Swiss gold drive up prices for jewelry, electronics, and more. A wedding ring or a new phone becomes more expensive, squeezing family budgets. Businesses pass on higher costs, and consumers face a subtle but persistent inflation. The uncertainty also slows economic growth as companies divert capital to manage risk instead of investing or hiring. The final bill isn't just higher prices, it's lost opportunity and a less dynamic economy. The cost of protectionism lands squarely on the consumer. Amid the chaos, the market begged Washington for one thing: clarity. Only a formal, written statement detailing which gold products, which origins, and which dates could restore confidence. Verbal promises weren't enough. Businesses needed binding regulations to make million-dollar decisions. Until then, the U.S. risk premium stayed high, and price gaps persisted. Predictability is the bedrock of global commerce. Without it, efficiency collapses. The plea for a written rulebook was a plea for a return to a rules-based system. Only clear, stable policies can keep global supply chains running. The market's message: give us certainty or risk lasting damage. As the dust settled, the true cost of the tariff chaos became clear. Swiss refiners lost a key market, U.S. jewelers paid more, and arbitrageurs were sidelined. But the deepest wound was to trust. The U.S., once the anchor of global finance, now looked unpredictable and risky. Global supply chains may reroute, investors may demand higher returns, and America's safe haven status is no longer guaranteed. The bill will be paid by everyone, from Swiss refiners to American consumers to global investors. But the highest price may be America's diminished standing and a self-inflicted wound to the system it built. The question: was the short-term gain worth the long-term loss of trust? Thanks for watching a video. Subscribe the channel now for more updates. Thanks.